Good morning, everybody. Welcome to the Flow Show. We begin a new week, and things are looking a bit dicey for dollar yen right now, trading in the 151.90s yet again. Are we going to get a break of 152 or not? Oh, could be an exciting week. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Have a great week, everybody. Yeah, is that the only thing we need to watch for the whole week, perhaps?
That's it. Yeah.
Break or not, 152. The rest is relatively quiet.
Yeah, it'd be typical, wouldn't it? There's not much going on this morning, and
Exactly.
it'd probably break. Yeah, this is the sort of moment when it would break, when there's nothing really going on.
I was just thinking the same thing this morning. This very little going on. The weekend has been geopolitical wise, apart from Yellen's visit to China with 17 updates that don't mean too much. There's not that much going on, so this is an ideal day for a surprise break, and then perhaps, well, we don't know after that. 100 points lower, 100 points higher. Who will tell?
Yeah, exactly. Well, that 16 lines I can write. I can withdraw off my notes now. You've mentioned the 17 lines from Yellen, but yeah, we'll get into all those in a moment. So let's get into it. We'll start over in Japan, and the large business lobby chief of the Kindenren said that the current yen weakness is excessive. So staying on one side of that trade there. Obviously, there's always two sides to strength and weakness in a currency for importers and exporters. One side always wins, one side always loses. So it just depends on the balance of size of who's losing out the most on that. But warning about the excessive weakness in the yen. We had a little bit of data out from Japan. Overnight. Oh, where are we? There we go. We had wage numbers. So cash earnings, wages, overtime, that sort of thing. So wages came in at 1.8% as expected, but down from the 2% previously. Overtime pay dropped 1% from a prior 0.4%. So not much to take from these. Obviously, the Bank of Japan would like to see these sort of numbers continue to strengthen.
Yeah.
These numbers are for February, so they are lagging all the pay deals to come and whatnot. Yes, mate.
Yeah, that's exactly how you say. I mean, we need to. It's actually only in 2 months that we are going to know exactly where we are going to start to see those changes, because it's going to be for the April data that we need to start really monitoring those wages.
Yeah. So it's a bit lagging, but we're not to report on it anyway. Also, Feb data coming in as well. Everyone's lagging on the old data. They need to up their game. Industrial production in Germany coming in up 2.1%. Some more signs of life going on there in Germany, though manufacturing production still remains in the doldrums, down 1.1% on the month. So no signs of life there yet, though we have seen some murmurings in some of the other data, like the PMIs, that they could be on their way to showing some signs of improvement. We shall wait to see. Again, this is February data. We'll soon be getting the April PMIs dropping, so we'll get to see what's happening and the latest numbers. Coming over to the US, we'll stick on the data front as well and go through what happened on Friday. Another gangbusters NFP, 303,000, blasting expectations once again. And this is another month where it's beaten expectations, and by quite a chunk as well. It was good news all round. The unemployment rate came down to 3.8%. That was even as the participation rate ticked up 2 pips over last month. That's more people coming into the jobs market can increase the unemployment rate. So it was a double good number, that unemployment rate. Wages staying sticky around 4.1%, did confirm the drop from 4.3, but we can't seem to bust under this 4% level. I think we ticked under it once a couple of months ago to 3.9, and then soon came back above. So those wage pressures still evident there. Fed's barking was the one they turned to straight after the numbers. Didn't have too much to say apart from saying that that was quite a strong jobs report. But US Deputy Treasury Secretary Adeyemo said that we are seeing wages growing faster than inflation. That's obviously good news in an election year, but not good for the inflation factor. Canadian jobs as well, they went the other way. Very poor showing, came in minus 2.2k from a previous 40.1k, and was expected to rise nearly 26k. So a complete reversal there on that. Although the number's not a huge loss, down 2.2 thousand jobs. They lost mainly in the part-time, but full-time as well, losing 700. What wasn't good was the unemployment rate going up to 6.1%. I think that's the largest in something like 2 years that we've seen in unemployment rate. Also, participation rate, that stayed unchanged. So that was a negative number on that front as well. After we got that, well, we also got the wages as well coming in at 5% versus 4.9%. So not the numbers the Bank of Canada would have wanted, softening the jobs market, but potential inflation pressures in the pipe as well. After that number, though, rate cut expectations for a June cut rose to 77% from 68% before the data, according to swaps on that. Then after that, we got the Ivy PMI, which showed a very good improvement or further into expansion, 57.5, beating expectations and doing a stormer over last month. So some good news there for Canada. Back to the Fed, and I'm seeing a lot more Fed members getting a bit worried about inflation. A lot of them are now, we spoke last week, Kashkari, Goolsby, talking about, maybe the Fed might not even cut this year. And a lot of Fed members that are coming out recently are also showing that caution. Fed's Logan said that they believe it's too soon to think about cutting interest rates given the upside risk to inflation. He's increasingly concerned about the risk to the inflation outlook. The FOMC should remain prepared to respond appropriately if inflation stops falling. Fed's Bowman also getting a bit worried, says it's not yet time for the bank to consider cutting rates. While not likely, it is possible the Fed may have to hike again to cool inflation. She says inflation faces numerous upside risks, but expects more declines in inflation amid the strong economy, but expects slower progress in cooling inflation this year. It says some jobs market vigor is tied to part-time workers and immigration, so a bit of a brush off of that employment data. But then took a bit more cautionary lines, saying progress on lowering inflation has stalled and she won't be comfortable cutting until disinflation returns. We have got CPI coming up this week, which we'll look at shortly. So it's going to be the big number this week in particular. US Treasury Secretary Yellen, as Kay mentioned, been waffling on this visit to China. We're speaking to their finance minister, and they discussed the important roles that Treasury and the Ministry of Finance can play in maintaining durable communication channels. Yellen then went on to say that China's relationship is on a stronger footing than last year. But then she turned it around a bit by listing a load of things that China's still doing wrong in the eyes of the US. Now, what they're going to be doing is hosting, or the US will be hosting, a China Economic and Financial Working Groups next week, i.e. this week. So they are talking, which is a start. We've been saying for a while on here that the one thing China needs to do, aside from turning around its economy, is improving relations with the West. Obviously, there's stuff going on with backing Russia and whatnot, so there's still tensions there. Let's go back. Kay, that data on Friday, when's it ever going to turn?
Sorry?
When's it ever going to turn?
Yeah, I mean it's crazy how they defy any expectations of seeing a slowdown or catch up on the data, especially that we have seen for months that the prior data had been revised downwards. Okay, the the dovish or the doomsayers always have their little sentence ready that it's all part-time jobs and no full-time jobs being added. But the the market, and especially the bond market, is reacting, and in a way the equity markets as well, are reacting to it more than FX. But I think in FX there's other stuff playing in play as well, because people were saying, yeah, but look at the euro dollar, but then euro dollar is only one pair, right? And you look at the rest of the dollars, especially the lower yielders, they have been on the weaker side afterwards, or at least this morning. Yeah, defying the laws of gravity, I don't know, mate, when it's going to turn. Really, I don't know. I was just wanting to come back on that Canadian report, because that's not great. And actually, it's putting the Bank of Canada in a bit of a bind, right? Because they're seeing those wages continue to remain very sticky, but then the unemployment rate ticking up above 6% in one go, participation rate staying the same. No creation of jobs. I don't know. We have Bank of Canada this weekend. There may be, because the last meeting we were saying, like, they don't seem to have like a real bias anymore right now, and that may drag them into the more dovish side of things. I don't think they will change anything on this one report, but it may just they may just come over a little bit more dovish than in the past. That's what I'm thinking about it. US data strong, and if you look at the yields, it's and then this week we have a pretty busy US Treasury auction schedule as well. It's probably going to underpin the yields for longer. Yeah, that's about the only thing I can say about that. I'm still relatively positioned back in dollar Swiss and through my option in dollar yen still as well. Got a little of the rest running, but yeah, I for sure don't want to be really short dollars in this whole scenario on the FX side.
Yeah, and so what of all these Fed members then? They're sounding much more hawkish than Powell. I mean, the market got a bit hawkish. Then Powell said, "Well, we're still looking to cut this year. Still anticipate cuts this year." But the data keeps coming out the other way, saying, there's no reason to cut really. And now we've got all these Fed heads who are obviously shit scared after being caught out when inflation started hitting. Are they going to get caught out the other way if it doesn't start coming down again?
Well, that's the scare, the fear that they have. That's what you've been talking about when even last year, when you said like they would rather err on the side of caution now than making the same mistake to the other side and starting to cut too early. And that's exactly the scenario where we are in right now. Yeah, especially, and we were talking about that again just a few minutes ago on the chat. Especially this Goolsby guy, because when he came in, he was on the dovish side of things, and now he's like completely shifting over the past 2-3 interventions that he had. He went really from dove to neutral, and now he's actually siding more on the hawk side. Yeah, they are scared of making a mistake, and in the meantime, the market has ears to it, and the pendulum is swinging now to the other side. We are gradually pricing out those expected 3 cuts. We are now less than 2.5. Yeah, that's really, yeah, they seem to be scared to make a mistake, as you say, to the other side, and but inflation is not necessarily a good thing, but I mean by that we've seen historically It's not because you have a high inflation that the currency is underpinned. That's what I mean. But because we see the opposite was actually very true historically. Because and I'm even taking you back into the Stone Age when we were still trading Deutsche Mark. They had like the lowest interest rates. They had very, very low inflation, and yet the Deutsche Mark was the one thing that people wanted to have because of the stability. The yen has been enjoying the same thing, right? With ultra low inflation, ultra low yields, but still until Abenomics, people were just buying Japanese yen because of the stability. Now, in the US, it's a bit different, and that's why I don't like to be short dollars, because there's so much dollar debt outside of the US that sooner or later it may have this effect of people just needing dollars, and I'm talking about liquidity. But for now, the liquidity is still relatively ample because we saw the financial conditions are not extremely restrictive. So I think that's holding the lid on the dollar in a way. But I think things may change all of a sudden, and that could be one of the uncertainties of Q2 before then going into June. I still have 2 months to go. So yeah, it's a bit of a question mark, but in the meantime, I don't like to be short dollars just based on sheer data and yeah, the Fed members having to be cautious on the back of all the data coming out right now.
Yeah, I think you're right. I think I mean, look, we've come through so many FOMCs, so much data, and dollar yen's in a world of its own. But take euro dollar, we're still walking the same old ranges from a monetary policy perspective, and all these the potential of entering cut cycles and whatever. FX markets are pretty steady. They're not going to move around. The scale of cuts, it shouldn't be huge as the hike cycle was. There's no economies falling off the cliff. So I think if we do get a dollar move, it is going to be on some sort of shock, or we've seen it before, the liquidity issue that always stokes itself at least once, twice a year. But it's going to be something like that really shifts the dollar. But I can't see it coming on monetary policy or on the data unless we get some real shocks dropping in some of these moves. So yeah, if the dollar's going to move, it's going to be on something other than central banks and data for the moment. As I say, unless we start getting some real crappy or real gang-busting numbers. So yeah, we've got to keep watching. Yeah, as you said, dollar yen, it's in a world of its own. It's all about what's going to happen here at 152. Fundamentals don't really matter at the moment in this one. There's forces at play. Like Brand said, I'm going to sit back and let it do its thing, and then see what happens afterwards. I think this has got to be resolved. This 152. We either got to bust it and clear it out, and then we move on and we go trading something else, or we're going to hold it and then we see a steeper drop from it. But something's going to happen up here. That's most definite. For the rest, there's not an awful lot going on. We've had a bit of a washout of the risk worries from over the weekend. What's going on with Israel, Iran, the US again, getting a bit of confirmation that Iran won't hit any US targets if they do kick off. So that help US side of assets and risk assets, that sort of thing. I think that was half the reason why stocks rebounded as well from that decent sell-off. Cables just sitting in the middle. We've got this funny level here, 126, 70s, 80s. It's a bit of a pivot area. Again, it's not one I'd trade, but, if we hold it, then we keep the downside pressure on. If we're above it, we look to the upside of the range. So there's a little bit of a pivot line at the moment. Just to have a quick look at stocks, because as I said, on Friday, they took a beating, and you can't really rely on your short-term tech, but we've had that rebound. Started late Friday afternoon, and here we are. Got back into the 52s, finding resistance at this old level. So while I ignored the levels in this move afterwards and things are settling down, now we can maybe pay attention and look where support is at the moment, right back on that zone again. So you take out the big news and the levels come back to play once more. So what's going to go on here? I don't know. We've got at the moment 3 lower highs and we've got 2 lower lows. So anyone who, all you shorts who have been trying to hit this one all the way in the rally, you've got something to cling on to here. So first level that needs to break is 52.20s. If that goes up, then we challenge again this 52.60s area where I thought we might see resistance coming in last week, and we did. Hold there again. Shorts will get enamored to, keep on their positions, keep pushing it, and then seeing if they can break it back down through support. If we hold this though and start just from this point stepping up, then maybe we're going on to highs again. Just a quick look, excuse me, before I hand it maybe over to K-Man, just look at what's coming up this week. So we've got 4 central banks this week. We've got the, I think it's 4, the RBNZ, Bank of Canada, ECB. I can't remember who the other one. Who's the other one we've got, Kay? Do you remember? Is it 4 or 3?
Hang on.
Let me have a quick look. Let me have a calendar.
There's a few actually this week, but Korea, Thailand, Singapore. I mean, there's a few this week, but I mean those 3 are the ones who are closest to us, right?
Yeah, no, there's 4 main ones this month. Bank of Japan, but that's not till the end, so that's where I got me 4 from. I think Looney's going to be very interesting this week. Yeah. We've obviously got the US CPI and we've got the Bank of Canada not too long after that. I'm getting a bit twitchy that we might be seeing some upside here. US inflation is expected to remain sticky. Headline going up 2 pips, the core coming down a pip. Still standing in the 3% though. And I think the BOC could have a little bit of a dovish slant. Their last inflation number dropped to 2.1%, so pretty much bang on target. They have a 2% target, but that's allowed to roam within a 1 to 3% range. Also, that jobs report doesn't look good, except for the wages component giving some inflationary input, if they comment on that. And we also, I recall Gravel speaking the other week saying that firms are saying that there's tight lending conditions or borrowing conditions due to high rates. So that might be in their thinking. So I think on balance, we might be getting a more dovish BOC this week. And if that US data is hot, I think the Looney might finally be getting up through this 136 and holding it, and maybe even moving higher. You got any thoughts for the BOC this week, mate?
Exactly as I said. There's to me on the numbers that we discussed, the labor report. To me, there's a risk because they were like very balanced last time, not really wanting to show too much. And there's always this thing about, because now they all look at each other, so it might be that they don't do anything. But there is a real possibility that their language is shifting a little bit, because regardless of what inflation also does, there's the other side of the medal, and that's the real economy. What's happening there, and if you start to have weaker job reports, that's not going to be liked by the central banks. Yeah, I agree. I think there could be a bit of a dovish rhetoric coming there.
Yeah, so we saw a bit of double bubble reaction in the Looney on Friday. Obviously, strong US jobs, weak Canadian jobs. It's a double wind for dollar CAD to rise on that basis. Then we had came off pretty quickly, and I thought that might happen. Just on the risk play into the weekend, I was short, loading up shorts up here. I'm all out of those down at 136 odd. I think we're more balanced here, but I'm getting tempted about whether to jump into a long If I might see if we get some sort of dip, 135.5 or something, and just run that into the CPI, US CPI, and Bank of Canada.
I'm with you, man. Yeah.
Yeah. So, all right. Well, let me know. Let me know where your bids are, so I can go a pip ahead of them. And,
Well, yeah, but you know, I always help you. Huh? I'm going first, and then you can have it afterwards. But
teamwork, make the dream work.
yeah. No, I agree. I fully agree. I think that's the risk, and the other risk, to me this week is the RBNZ. There should not be anything either. But again, or has had this habit of doing 180s here and there, and we've already seen Aussie Kiwi tick up quite a bit, and I think the risk this week is for a slightly more dovish RBNZ as well, and just because it's ore, you know, and they are at 5.5%, which is the top end of what the Fed is at as well. And they could be tempted, you know, they could really be tempted. And that's where I'm going to keep an eye on, especially things like Aussie Kiwi this week, because we could be in for a break. That is, we could be in for a bit of a break there. We have, yeah, the trend line there, not far. We are tickling those prior little highs there as well. If RBNZ comes out a little more dovish than expected, we could be in for a bit of a look well above 110, I'd say. Get up to maybe even high 110s. That's one pair I'm going to have keep an eye on. It's not a hugely volatile pair, but we have seen moves in there. We all already did like 3% on the way up, which people may or may not have really expected. But yeah, there's still a bit of risk in the Kiwi as well. And then if you look at the Kiwi dollar, perhaps around that 50, 59, 60, 80 as well, bit of a risk zone. You know, you got that. Yeah, 40 as well, but then okay, I've got it a little bit higher, but yeah, that 59.40 is going to be a bit of a magic level as well if that breaks.
Yeah, and it probably a case that if the RBNZ go, then a lot of people think that the RBA won't be far behind them. They can be a bit flip-floppy as well.
Yeah, so it may be the case of like having one push higher in the Aussie Kiwi and then get out of it again. But
yeah, definitely. So yeah, that's one to watch for that. Kay, you got anything? Well, let's have a quick look at the data, but then I'll hand it over to you, mate. What else is coming up this week? Not a lot today. Not really a lot tomorrow. Keep an eye on Japan PPI just for the inflationary impact from that. But I mean, we tend to have a quiet week after an NFP week. So yeah, the fact that we got US CPI and some central banks this week will be good. Thursday, going to be keeping an eye on China CPI and PPI to see if that bounce in inflation is lasting. Have they turned the trend of those negative numbers we've been speaking about? Last month it went positive. Let's see if that keeps it going. Then we've also got the ECB, which should be a bit of a non-event, but it just depends whether we get full clarity on June. They said they'll know more in April and know even more in June. So let's see if they've found out anything different in April or when they hit their meeting there. Are you expecting much from them? Maybe a bit more concrete news on June, perhaps?
I'm not sure, mate. They've all been now calling so much for June that it would be a surprise if they say anything this month. So they bought time. Lagarde doesn't have the habit of giving the market too much clarity on stuff, right? So it's probably going to be an hour of trying to keep awake. No, I'm not expecting. I'm not expecting a lot. The only thing is that last meeting already, she was talking an inter meeting, or how do you say that? Yeah, inter meeting, in between meetings. Those comments on those possible green shoots coming, we have seen a little bit of that, and so she may cling on to that one just to stick to the more neutral, at least not dovish side. So I expect a very neutral meeting this time. Nothing overly hawkish either, to be honest, because there's not too much to be hawkish about, because we have seen inflation coming down, right? But then she can do a real Jay Powell this time and walk both sides of the aisle, and then come out at the end neutral.
Yeah, again, I'm wondering, what was the last inflation print? 2.4%. I'm wondering if that's close enough for them to really, nail down June, because all these central banks are saying they won't wait till inflation gets to 2%. They'll say they're all happy to cut if the trajectory is right for getting.
That would be a bit of a shocker if they hint at something.
Yeah, I don't know. Everyone's saying that no one's saying that June is appropriate to cut. They're all saying that June is the date when they could decide if the information is right. So I'm just wondering, 2.4%, we're the right side. Well, not the right side, but we're closer to 2.4 than we are to 2% than we are to 3. So I'm just wondering if they maybe say or it's the old confidence thing. Has and the Trichet lines, has confidence increased? Shall we say, with that inflation print? I think that's maybe the language we need to look for. That confidence is increasing, that they're getting to target, and then they can cut. And I'm just wondering if she's got to acknowledge it. She's got to acknowledge where CPI is right now. So I'm just thinking maybe this is the tee up meeting properly. Because then we've got 2 months of data to get under the bridge before we get to June. But who knows? Who knows with this lot?
Yeah. If anything, I mean, based on actual data, whether it be inflation or other data, ECB should cut before the Fed.
Yeah, well, it's looking that way. Definitely looking that way.
Oh yeah. I mean, for me, June is a done thing if they don't cut now. But then.
Yeah, I'm not expecting them to cut now. I'm just, I think we could get some stronger language. Yeah, some stronger language that might come. What else have we got coming up? We got PPI. Yeah, PPI on Thursday, so that will follow the CPI. So that will sort of add or take away from what we got from those numbers. A bit of data on Friday, monthly GDP from the UK. UK is pretty quiet this week. All being told, and then we get some other CPI numbers coming in. A lot of these will be final numbers, like from Germany. And on Friday, a bit quiet, apart from the Michigan consumer sentiment, which will be the flash number, I think, for April, first one of the month. So that will be probably the potential mover. See if that US consumer confidence bounce remains in play, or whether it was dead cat or not. Right, Kay, you got anything you want to show us to set us up for the week?
Just a few quick ones. We've got to talk about what's happening in that gold and those metals, right? Got to at least mention it. Here we are.
Yeah, rockets.
Sorry?
Rockets in gold again. It's rockets in gold again, isn't it?
Yeah, and it's we are having that coming out of the weekend jump again, right?
Yep.
You see, we when Asia arrived, 2305-ish or whatever, and then rallied $50 nearly. And this is our typical Monday move now, coming into the market. But we are okay. I mean, technicals are always hard to look at when you are in such an explosive move. Okay, but if anything, we are on a bit of an extension move here. if you look at this move that we had back in 2022, 23.5 was is a bit of a level, all right? If you want to cling on to some levels, that is one. But the problem is, if it flies through, then you have nothing more for 40 bucks. I think now the downside, and we are 80 bucks away. Nothing will change before 22.5 goes. If you want to hang on to something, it's a very fragile one, but it looks like a bit of a channel here. So we could have, if we see setbacks, people like looking at potentially this channel and see where we end up if we get a setback here. So that is a possible one. When is consolidation in gold expected to take profit? Well, Ali, if the Middle East situation doesn't get worse than it is now, and we always have to speak conditionally, right? Because we don't know. Iran seemingly has remained sort of quiet, but then we have the end of Ramadan coming up as well. I don't know. I think we can hardly say that things are quieting down. But if there would be a real quieting down of the situation in the Middle East, then we see potentially a move, a setback. But when will it come? At what price? What price will it come from? I don't know. I mean, why is there talk of retail traders not stealing gold longs? I forget about the retail traders. We are 4, 5, 6, 7% at best of a market. I mean, this is not driven by retail traders. Okay, it can be driven by some days. It can be driven by retail traders, people going to gold coin machines in the Middle East, in China, and they overpay, and then people buying options and the option desks needing to cover. But I mean, this is not. If you look at let's say where it really started from, yeah, the end of the end of year last year. This is not a retail trader's move. Actually, retail traders are probably already short gold and asking why it keeps on going up. No, I think globally speaking, because it's defying higher interest rates, right? But then higher interest rates, as I already said, is not the full message or the full playbook of a market, because actually financial conditions are not that tight yet. But I do think that if there is a bit of quieting down in the Middle East, this should at one stage correct. But where it will correct from, no idea. Now silver is following as well. Had a very, very serious break here, and we're following. We are nearly, or we are. No, we are shying away of it a little bit right now. 28 bucks. I do think it's possible to go and have a ramp up to 30. Also because if the market is interested in doing silver, there's less liquidity than gold, so it could actually reach for 30 bucks. Where I'll be gladly selling out the rest of my ads from around here the other day. It's that, and then just go back to my base loans and. But I think any setback here may actually, and there is going to be interesting for this one compared to gold, and that is because we see China injecting cash again into their market, and if China starts to revive, I think this one actually could see a bit of a setback because of the dollar, because of gold, because of less tension or whatever, but then actually do much better than gold. But we have to look at. I'm really looking at what the global economic situation is, and the stuff for EVs and everything. So we have to keep an eye on that one. But I think any setbacks now into the 25.5 are going to find buyers. A euro, I don't have much to say, really. Sterling, neither. Sterling is an interesting one, perhaps because we see towards the end of the week that GDP And then after the ECB, we have to keep an eye on what's happening in the euro sterling. Euro sterling is still holding up. Yeah, we can't really get back down, not to the 85 and a halves, but that I think perhaps we'll even need to wait for the ECB now to make a decision. But anyway, we're a bit in the middle of nowhere here. I'd say 126.90, 125.90, and start to trade outside of that. We may have a bit of activity there. What else? There was another question here. Oh yeah, Roberto Sonari, why is 152 so important? Well, 152 has been made important by the MOF, first of all, because that is where back in 2022 they decided to intervene the first time. Okay, and back then there was also a bit of a technical pattern calling for somewhere around 152, 152 and a half being a potential top, and that's exactly where we stopped. I recall that time as well when we were talking about it, and I said there's something going on at 152, and since then it's just been made more and more important because we've had those tops again that we had at the end of the 2023, and now we can't trade 152 because there's barriers around there, and people want to defend it. So it's just been made more and more important by the price action that we have around this 152. So that is something that sometimes happens with levels, that you see a level which should not be really very important, all of a sudden gains in importance, and now all eyes are on this 152. But again, I want to repeat this. I don't know what is going to happen once 152 trades. I think, barring a big big move lower in the US inflation, which was that move here back in the end of 2022 on the dollar yen. Barring a big move lower in inflation in the US come Wednesday, I can't see this hold forever. It would be an extreme surprising fact that this really holds forever. But what's going to happen afterwards, I don't know. Could trade 153, could trade 150 or 151, the figure afterwards. It all depends what's going to happen, whether the officials are going to take advantage of this importance of the level and go and give it a knock on the head. It is possible, you know. But if nothing happens, if inflation in the States doesn't really come off, if those yields don't come off, I'd rather say without interventions, there's a risk that we are going to trade higher in the dollar yen. But okay, that's the chances. Because we see here now the pendulum is swinging again on those yields. I'm looking at the 2-year yields here. We're tighter than 2.5 cuts. The bond market is already front-running this as well, but I still want to look at this one. This is the 2 cuts line, 487. We are about 10 BPs away, okay? So keep an eye on that one, because there maybe then your next psychological level on the short end in the US yields. The longer end, we have broken above 435, 440 on the US 10s. Next is around 455, 460. All right. We do have a very quite a program on the US Treasury announcements as well this week, or auctions this week, I should say. So there could be more pressure on those yields in general, just because the market is already on this path higher, and addition of some US auctions could really put some more pressure on the top side. But of course, Wednesday will be the decider for this. If we see a sticky one, then it's going to probably push through. If we see one that's coming out relatively weaker, apart from besides really falling out of bed, perhaps a move back down to 435 is also possible here on the 10s. And that's it. I could show the Swissy, but the Swissy is again we've had those setbacks on all those Swiss crosses, positioning and risk into the weekend. We had those setbacks here into the weekend. Friday did the low on the Euro Swiss on the support of the trend of the channel. And we are trading back higher because the Middle East situation has not really deteriorated right now. Sterling went somewhere in between the two supports, and we're back trading a bit higher as well. It's all about risk in the short term, and then in the more medium term, the Swissy is still probably going to remain offered because the data over there are not great, and we have seen lower inflation prints as well. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Just a reply to Ali. Yeah, you could have traded dollar yen 10 times, maybe even more. I have traded it on the long side when we had a dip to the 151s on the back of headlines and whatever. The thing with this level, as we've been saying, is that the volatility is high at the moment. Okay, if you're short, you're going to be paying money away if it doesn't drop. So if you get one of those times when the price is just going to sit there for days, then you're going to be costing money doing nothing. The other side is if 152 breaks, it could gap up, which means you might have a 20 pip stop, but if it gaps up 70 pips, you'll get filled at that nearest price. So your risk is then magnified. So you can nick 10, 20, 30 pips on selling rallies or selling the resistance, but it only takes one trade to knock all that out because of the risk. If you're happy with that risk, go ahead and trade it, mate. It's there to be traded. There's no one stopping you. On the other side, you want to be long, and it breaks 152, and then suddenly the MOF hit it for 500, 400, 500 pips again, maybe another gap down. You're going to get creamed on that. So it's not about not trading it. If we didn't have this intervention threat, I would be all over this like a rash. I would be shorting it at 152 with a buy stop through it. But I could get smashed both ways in that trade, and I'm just not prepared to do it personally. I don't need to have that sort of risk on my account. So I'd rather sit back and watch it. There's going to be plenty of other times to trade it. There's going to be plenty of other pairs to trade. I don't need to have that risk, that high risk affecting my account, hence why I'm happy to sit on the sidelines unless something pops up that I feel like I can snipe it for a few pips. But, you know, if you want to give it a go, just know the sea you're swimming in and how choppy it is. It's all right making a few trades, a few winners, but it only takes one to give it all back. And I'm not prepared to do that right now. So that's why I'm just a spectator for this one. Anyway, that's that for today. Hopefully what you set up for the week ahead. We know what's coming. We know what to look forward to. Thank you, Kay, for everything as always. And we shall catch you all tomorrow. Have a good one, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.